Welcome to an educative webinar from Valetax Broker. And my name is Innocent Ifere, and I am the market analyst for Africa, global market analyst for Africa and educator, internal educator for Valetax. And welcome today to one of our many webinars that is focused on educating you and helping you gain more clarity in the market. Okay, so first off, today, what we're going to be talking about is our ability to quit random entries, right? So we do not want to be having random entries in the market because it's one of the things that has influenced and affected traders in ways that has made them not be profitable for a very long time, right? And one of the things that we want to do today is we want to bring clarity to ourselves. And majorly, we're going to be talking about entries because, like you see, the name of the webinar for today is no more random entries. We want to understand how to make our entries correctly, right? So let me just position this in a way that you all can see me, right? Okay, so what we're going to be focusing on today is entries, most importantly, and we want to learn how to make the proper entries, okay? So my name is Innocent Ifere Rion, like I clearly stated, and I am a market analyst at Valetax, and I help traders escape confusion with clarity. This is a bit old, but I have over 6+ years of financial market analysis and trading, okay? And I've been a financial market analyst for a global market analyst now for about 3 years, okay? So when it comes to fundamental analysis, technical analysis, I'm your go-to guide, okay? And our main goal for today, like I clearly stated as well, for those of you that are just joining, is to give you clarity when it comes to entries. See, trading isn't just about clicking buy and sell. It's about your ability to know when to enter a trade and when to leave a trade. In fact, as a statement, right, of fact, every trading strategy must have a necessary prerequisite, which is an execution plan and an exit plan. So you must have how you want to execute the trade and how you want to leave the trade, right? Now, today's agenda is we're going to first talk about the problem with the chart. We're going to talk about the Sniper framework, which is how you should actually enter a trade. We're going to talk about the live chart transformation. Like I'm going to show you guys on the chart how you should enter your trades and the rule that changes everything for you. Like what are the rules you need to abide by? Now, this is a very much important disclaimer to be put out there, right? It is not about not ever losing a trade that makes you a good trader. It is not about not missing an entry. It is not about the entry working 300 times. Sorry guys, I'm going to have to put on my headset because the sound of the rain is a bit distracting to me. Okay, so let me just use this as my ear covers, right? So it is about you gradually getting to a point where you can make these entries out of confidence, not just certainty. So we don't want only certainty. We want you to have confidence in making your trade, because in the market, there's never 100% certainty when it comes to the market. But your ability to create and to carve an edge that can present itself for you at least 6 out of 10 times. In fact, 4 out of 10 times is actually a very good ratio when it comes to the market. Because at the end of the day, a bulk of your trading is based off your risk management. Are we following? If you're following, please drop something in the chat section for me. Let me be sure you can hear me and we're following, right? So one major thing for a lot of traders is we trade impulsively, right? When we say you trade impulsively is you think, not you know. So these are two different things. Thinking and knowing are completely two different things. See it this way. You see a trade and the trade looks like the market, you're on the chart, and because the chart looks bullish, so you think the market is bullish, so you should buy. But when you know, it means that now you have sufficient knowledge, you have reasons, and you have instructions. For lack of better word, you have instructions. So you have when you know something, it means that you've analyzed it, you've looked at it critically, you've set in parameters to support your notion or your idea as to why you want to take the trade. But when you think, you're just going to be acting based off emotions and impulsively. So when you think the market is bullish, now you want to buy because you think the market is bullish. You have no reasons to buy. You have no calculations whatsoever, or you have no information. You don't have enough information to actually take that trade. So most traders don't have a strategy. They have reactions. That's impulsive behavior, right? So you think, so you react. Now, reactions don't make money, structure does. Why do I say this? It's because imagine if every time you had to react to something, right? Imagine if every time you had to react to something, you get something for reacting to that thing. It means that reaction will be a good result, right? But now, let's flip it. If every time you had to react in the market, it would make you lose money, does that become a good thing for you to do? No, right? So we don't want to trade from a place of impulse and uncertainty. We want to trade from a place of probability and confidence. See, two different things. I didn't say we want to trade from probability and certainty, or I didn't say we want to trade from confidence and certainty. No, we don't want to trade from impulsiveness and uncertainty based off reactions because we think, but we want to know. But even in our knowing, we have to come to a point to understand that the market is probabilities. It's 50-50. It could go either ways. But what we want to trade with is probability and confidence. So confidence sharpens your edge to take a trade and relax and sit back and be like, you know what? I've taken this trade and I've done all I have to do for this trade. I've gathered enough information. I have placed my parameters. I know what my risk capabilities are like. And now I want to take the trade. Good. So I don't want us to waste too much time because it's late at night. And I want to keep it as simple and as easy so that we can head to the charts to do where the main work comes in. Okay. So the problem with the chart is we keep looking at bias, zone, timing, and all of these things, but we do it wrongly. So some people come into the chart without a bias, they come in without a zone, they come in without timing, they just come in very unstructured. And when you come into, think of it this way, the market is an anarchy. Mark Douglas, the disciplined trader and trading in the zone, clearly stated, where he described the market as an anarchy, a place that is filled with so much chaos that requires only a disciplined man to be able to walk through it. So view the market in this manner. If you find yourself in a situation where there's a crisis going on, do you just casually walk through the crisis where there's blood shedding, they are killing people? Do you casually just walk into it? Or do you try to find a place to hide and then think of how you're going to follow through the corners to get to where you want to get to, where there's a safe haven for you, right? It's the same way you want to view the market. Structure is that thing that you do, is what gets you to the end point at the end of the day, is what gets you to realize profit. So if you're not setting structures and you're not being disciplined in place to get there, then there's no room for you to be safe. Your money isn't safe. You're not making money. So what you're doing is you're literally just you're holding a bag of cash and you're walking into a den of armed robbers. You see? But when you have structure in place and you understand the importance of your risk management, your entry system, your exit system, and all these things are structure, right? So you wouldn't be walking with your bag of cash into a den of armed robbers. But what you'd be doing is you'd be walking with your cash hidden behind you somewhere, protecting it and maybe holding a little bit so that if at all they want to take from you, they can take the little, but you still have your money protected. And you can finally walk to the end where you want to make a bargain, to get what you want to get, which is more money, right? Similarly, that's how the market works. But now, this is where it comes in, right? So what I'm going to do now, I'm going to show you a chart with bad entries, and I'm going to show you where a lot of traders get trapped, okay? So let's look at my chart, okay? So currently, I am on a trade on the US 30, right? So, but I'm going to show you bad entries that I have made today, just today alone, and I'll show you the trades that I didn't even take because I could sense that they were bad entries. Okay, so I had sells here this morning. Okay, I had sells here this morning. My target was here. Okay, and I lost out on this trade. Okay, now I'll show you another trade that I took that I lost out on. Okay, this is AUD. Let me open it on. Okay, good. So this is AUD here. I'll show you what happened and why this was a bad entry. Okay, why this was a bad entry overall. I have very limited pairs that I trade, so just give me time. Let me go to prospects, right? So show you some other bad entries that I have made so far, and then I'll show you the good entries, right? You'd almost think I don't have any entries. I think because I've cleared most of my charts. I've cleared most of my charts, and I trade very limited pairs. Okay, so this is my personal watch list. I call it the, I don't know if you guys can see my screen. So I call it 100 milli Rion, right? So I just have a few pairs I trade: US 30, Euro USD, AUD USD, gold. Um, I look at the DXY, I look at the Japanese index, I look at the Nasdaq 100, GBP USD, GBP JPY, and BTC. So these are like very, very limited pairs that I trade. So
I can't see your screen.
you can't see my screen.
Yes,
You can't see it because it's small or because you're not seeing it at all.
I'm not seeing it at all.
Oh, okay. Any other person having issues with not seeing my screen? Can we see my screen now?
No,
How about now?
no.
Someone is saying they can see it, so that problem could be from
Let me
your
log
end.
out and log in.
Yeah, probably you should log out and log in again, okay? So it looks like I literally have no bad entries on my chart, which is completely wrong because I don't want you to have that idea. I also do make bad entries sometimes. The goal to the goal to you becoming the better trader isn't looking for perfection. It's looking for consistency in your ability to find things that work, right? So let's go to the bad entry I made this morning, which was on Nasdaq, and let me explain why it was a bad entry. And then please hold on to your thoughts and leave whatever questions you have in the chat section. We'll get back to that point of interaction, right? So on Nasdaq this morning, one of the reasons why this was a bad entry was because of this. Number one, it was highly driven by pure sentiment without, listen, it was driven by pure sentiment without proper technical backing. So this is what I mean. We had approached a we had approached a liquidity point. Okay, so liquidity points are areas where markets, we believe that markets have enough I don't want to use the word money, but enough orders resting. And basically, we know orders are, liquidity, and liquidity is indirectly, money, right? So we had swept this liquidity point, which was like the most valid area of key liquidity and structure for the NASDAQ 100 after the move from this demand. And we had this imbalance here. Now, this imbalance at this point also was carrying a sort of supply area at this point here. Okay, so this supply area was where I based that trade from this one. Now, prices was in this zone, and I acted out through that zone, acted out of that zone. Now, it wasn't necessarily an impulsive decision, but what I mean by it was fully and barely determined by sentiment is this. When prices was here, I could have really waited to get momentum shift. So momentum shift is one of the things that we're going to discuss tonight about how to make entries, right? So I would have waited for a momentum shift, but I took this trade here because one, the market was clearly in an overbought situation. We've been buying for the past 10 days. Nasdaq has been bullish for the past 10 days. And when we look at the RSI, we could see clear overbought situation. So I was expecting that it was time for a reversal to come in, considering the fact that this was also a valid supply level. But now, why this was a bad entry for me was because number one, I didn't wait for a momentum shift. A momentum shift would have been me waiting to see structure change or shift in that supply level before I would have finally entered the trade. Why was that necessary? That was necessary because at the end of the day, this market has proven itself to be extremely bullish. So it means that the buy sides would always favor the market movement more than the sellers. So the only way for me to have fully gotten confidence and confirmation on this trade would have been for me to wait for the momentum shift, for me to have seen huge sellers come into the market and fail to break above here. Then I would have entered my sells. But what happened? I entered purely based on the sentiment of a strategy that I know usually would work without fully confirming it. Now, this is a typical and normal thing that would happen to traders when it comes to the foreign exchange market, because a lot of times we act out of our emotions, and emotions doesn't necessarily mean you're angry, you're sad, or you're tired. No, emotions could be in that very moment you were not just capable of thinking clearly and grounded. So when it comes to trading, it requires you to sit back, relax, and do all of the necessary things that you need to do. Confirm, double check, follow your plan, your strategy, and all of those things. And sometimes we miss it. That's why I'm showing you this, is to tell you that not everybody is perfect. And even people who are pro traders don't always get it right every time. Now, this is the correction to you come back to the daily time frame. Okay. When we come back to the daily time frame, we clearly see that prices has been bullish, and market is one thing you should know if you do not know it today is market is liquidity to liquidity. So basically, buyers are chasing sellers and sellers are chasing buyers. That's like the standard thing for when it comes to trading, right? Now, higher time frame is king. You can argue with your keyboards. You can go back and argue with your mentor and tell your mentor that Rion Ifere said that higher time frame is king. Why that is so is because anything evident on the higher time frame that market decides to pick a direction towards would be the leading direction for the market. Now, what we see clearly here is we have some buy-side liquidity here. So this was the last point where sellers were actively present in the market. We see sellers coming to the market here. We see sellers coming to the market here. So meaning that everybody who sold and was holding their positions on Nasdaq would all have their stop losses at about this point here, which was the last key major structural point for these sells. So they have their stop losses here and they have their stop losses above here. Now, one of the major things that happens in an extremely bullish rally is that the market is constantly chasing liquidity. Now, if the rally is heavy on a higher time frame, it means that it's chasing a higher time frame liquidity, and that was what I missed. So it is literally chasing the liquidity, which is this all-time highs on the Nasdaq 100. Okay, this is the liquidity is chasing. This is the buy side liquidity is chasing. So before any sells, before any correction sells would happen, it would have to sweep this liquidity. Now, if I had remembered that and I had put it in check, I wouldn't have made the entry I made this morning. I would have stuck to the buy sides instead. I would have realized that the buys that were happening was what? A short term. The sells that were happening was just a consolidation for another breakout. And that was exactly what happened this morning. So you see, what I simply did now was I didn't fault myself. I didn't blame myself. What I simply did was I went back to the US 30 and realized that, these two pairs kind of move alike. The only thing that differentiates them is US 30 is more of a weighted index of not just natural and science companies, you understand, but it is more about the major companies that are big on earnings, profit making, and all of those things. So it's weighted, right? And I looked at the US 30 and I see that the US 30 has what? Has a liquidity that is on a heat map and is also running to. So hold these thoughts and let's go back into our, okay? Let's go back into our charts, okay? Our webinar page. Are you guys with me? Are you following? If you're following, please leave something in the chat section. Leave something in the chat section for me. Let me be sure we're following, right? If you're following and you're understanding, please say you're following and you understand. If you have a question, if there's anything I'm saying that is new to you, just type in the chat section and say, this is new to me, or I do not know this, so that I know how I'll come back to it, just to give you like a refresher, right? So the next thing that we want to look at now is the sniper framework. Today, what I want to show you is how to actually make entries without, overstressing yourself, right? I've always said this, okay? I've always said this. I think the rain is over, so let me take off this air covers that I was using. Okay? So I've always said this thing to my students, and I've always said them to students of Valetax, that you need to understand where price is going to. You need to understand where price is coming from. And most importantly, you need to understand why price is going to wherever it's going. And this is how you understand it. Structure, market face, and liquidity. So liquidity is the major attraction in the market. If it's not because of money, nobody is going to be trading, right? So it means that money is important. Now, money is liquidity. So that's the whole reason why the market moves, right? Funds. The next thing is we want to know, where's the market going to? The only way to truly identify where the market is going to is by understanding the overall or the leading structure, which is on the higher time frame. Now, you then need to understand, where is the market coming from? Structure as well. You want to understand the structure of the market from where? The higher time frame, leading structure. Now, the extra to it is you want to understand the market condition and what phase the market is in. So are you in a correction phase, or are you in a impulsive phase? So the market has those two phases. So if you're in a bullish trend, the market is going up, down, up, down, up, down. So every time the market goes up, we say that is a continuation, or that's an impulsive phase. Anytime the market comes down, we say that's a correction phase. So depending on what side of the structure you're on, if you're in a bearish structure, the reverse is the case, right? So now, we first want to understand three things when it comes to making our entries. The reason for the sniper is because a lot of people want to make entries in a very, very I'm looking for the word, it's not coming, but in a very, very precise manner, right? It doesn't have to be you making an entry that never goes into loss or into drawdown or any of those things. No, but it's about making the precise entry where you don't have to enter a trade 7 times just because you're trying to look for an entry. So we want to understand the buyers of this trade. We want to understand the buyers. So we want to understand those three things I told you. Where's the market going to? What phase is the market in? And why is the market going to where it's going to? Because if prices do not have a why, then they are not moving. And the only why they need is a liquidity, either a buy side or a sell side liquidity, right? Now, the next thing is the zone. What zone will market react from? So this is why it's important to then understand key price levels and, key levels for structures. Let me break my neck a bit, guys. Okay, so let's chill out. So the next thing is the trigger. When do I enter? So where do I enter becomes your execution framework. When prices get to a key level, we don't just jump into sorry guys. So when prices get to a key level, we don't just want to jump into the trade immediately and any of those things. We need to have a trigger. So the trigger is your execution framework. Some people like to see a shift in momentum. Some people like to see a change of character into a shift in structure, into a change of character, into into a break of structure before a return to order block. Whatever the case may be, some people want to see a double bottom, some people want to see a sweep. So they want to see the first tap of the key level, prices sweep it, and eventually start to move their direction. Those are all execution triggers. So you need to know what your execution trigger is. Okay. Now, if one of these things are missing, then it probably is not a trade. You're just acting out of emotions. So it's exactly the same to why I say you just see the trade and you think, oh, because it's bullish, I should buy. And then you click buy and then it's gone. We don't want to find ourselves in that situation. So let's head to the chart and let me show you guys what I'm talking about. Okay. So I would use the current trade that I am on to explain this to us. So this is the US 30 chart. If you do not know the US 30, it is called the Dow Jones Industrial Average Index. It is the 30 most weighted companies, the biggest companies in the United States. So that's why it's called the US 30. They are the biggest companies. Now, I would want to analyze this chart for us purely on a new distance so that we can see it clearly. Remove this. So we see that this market was initially bearish from February all through March. We were bearish before we finally became bullish, right? And I also took the buys and I also took the sells. Very, very solid buys and solid sells. Okay, so the US 30, the buys that happened on US 30 here came from a key level. Okay, so number one, key level. Number two, where is the market coming from and where is the market going to? Remember that. We now want to understand the bias of the market. So when this market was bearish, we saw the market consistently make what series of higher highs, higher lows. Sorry, did I say higher highs, higher lows? Pardon my mistake there. Market was making highs, lower lows, lower 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 highs. Now, prices was bearish for a very long while, and it was looking to what? It was looking to target, this liquidity here. Okay, this is all liquidity. Every previous structural point is all liquidity. Why is it liquidity? It's liquidity because people definitely bought from here, bought from here, bought from here, bought from here, and they were chasing all the higher lows of prices going up. Those who were swinging had these lows here mapped out as their point. But now something was left. There was a key level that was attracting prices to as well, which was this key level. Why is this a key level? Because it has acted as a resistance. Okay, that acted as a resistance here, and acted as a resistance here, and acted as a resistance here, and also acted as a support, as a minor support here. So what did prices do? Prices came, and when prices got here, prices reacted at this point. So now we're looking bullish. Okay, we're looking bullish, right? Now, the next thing we now want to identify is the market has come here. Where is the market going to next? So now we've hit a key level, we've hit a demand level. Now, assuming we were on this trade, we were on these sells, okay, we saw the market when the market came to this key level. How would we have made the best of entries from this level? It's the next question. How do we snipe this level? So I'll show you. Okay, let me delete this for now. So I'll go to the 1 hour time frame. One way to snipe for entries is one of the ways I'm going to teach you today. Is number one, pay attention. We're going to be using two things when it comes to key levels. We're going to be using your RSI. Please take notes, and I'm going to give you the settings and everything for how to snipe entries when you get to key levels. Okay? You're going to be using your RSI, which is the relative strength index. Just in case you don't know it, this is what your RSI looks like. Are you following? This is what your RSI looks like. Okay? Now, the next thing you're going to use is a key level. We want it to be a major support or a major resistance zone. Are we following? If you're following, please let me know in the chat section. I just want to be sure that you're not losing me or my network isn't breaking up. Okay. Now, the next thing we want to see is something I call a divergence. Are you with me? So what a divergence is when the market is making the opposite of what the RSI is making. So think of it this way. The market is making a bearish movement like this, but the RSI is doing the opposite of it. So when the market is bearish, instead of the RSI to also be bearish, the RSI starts to do something like this. The RSI starts to look bullish. This is a divergence. So it means that the RSI is bullish, but the market is bearish. What that starts to show you is exhaustion and indecision. Now, we want to tap a key level the first time, okay, in that same direction. And then we want to see the initiation of buyers, the first set of people who run into the market to actually start to buy that key level. We don't want to rush with them. We don't want to enter the trade with them. What we now want is, through our understanding of the market, we know that the one thing that institutions who are the big money players and like to move the market like to do, number one, is they like to manipulate early entries. They like to manipulate liquidity in the market. So what we want to do now is we want to wait for them to come back and sweep. We want them to come back and take out all the early buyers from that key level, okay? All the early entries, be it resistance or support. We want them to come and sweep them. Take out all the possible liquidity that they can, close below them, and then come back above that key level. They are not closing below the key level. They just come and they sweep it. So I don't know if you've ever noticed when you're on a trade, you're in a key level, for instance, you've drawn your support and resistance, and then a candle just goes under the support or a resistance, and then jumps right back up immediately. That's what we refer to as a liquidity sweep. So on a higher time frame, that would be just one candlestick. But when you're looking at it on a lower time frame, it can look like a whole trend entirely, right? So that's what we want. We want prices to sweep the first set of people that came to enter immediately. Prices touch that level, and then reverse back up and then sit above that level again. So what that automatically does for you, it now tells you now that the manipulation has happened of the people who were in a hurry, without patience, without confirmation. All those people that like to set limits. You know, there are people who like to use limit orders. Now, don't get me wrong, limit orders are good, but that is exactly what the market makers want. They want you to set limit orders that they can manipulate and get rid of. That's good liquidity for them. So when they finally done that, then they finally start to allow the market move in this direction. Now, this is how you use the RSI to gauge this thing. What you want to use the RSI to gauge is, you want to use it to gauge what I call the divergence curve. So you want the RSI, you want your RSI to be making the opposite of what your chart is making. So here we had a low here, and then we had another low here. So when you go to your 4-hourly time frame, you see it clearly. Okay. So we see that at this point here, the market here was making what? A lower low before it created this lower high, right? But on our RSI, we can see what? A low. Can you see? This looks like the lowest point that the RSI got to. Now, prices came and swept this low. Don't forget. Let me clean this so that it looks neater for us. I'm just going to be showing us two ways to, try to use Sniper entries today. Oh, shit. Did I just take out my key level? Okay. So we have this low here identified. Good. Now, RSI has made its lowest point. So your levels for your RSI should be 30. Okay. 30, 25 at most. That should be like your level for your RSI. So your RSI has two bands, the upper band and the lower band. The upper band calculates the overbought nature of prices, which is momentum, right? And then the oversold bar or band shows you where prices are oversold. Good. So that is 70 and 30. If you put that on your charts now, Okay, someone asked the question, how do you analyze candlestick patterns on key zone for high probability trades? Always remember the key candlesticks patterns that you need to remember. Your bullish engulfing, your morning star, evening star, shooting star, harami, all those patterns. You want to identify them, right, on a key level. Now, the problem with identifying these things on a key level is not that they do not work. Take, for instance, you would have identified this candle possibly as a bullish engulfing, right? And you would have wanted to come and take the trade here, and you ended up losing out because now you want to hold the trade longer. But what I'm trying to show you now is it's not just using candlestick patterns to trade high probability zones. It's actually understanding market dynamics, right? So this was a good catch. I mean, if you got into this trade when prices tapped here, this was a good catch. But analyzing this key level that we have here, this key level is a swing key level. Is a key level where if you had entered the trade, you would want to hold the trade for a long time because that previous resistance was from last year. So this is a very strong key level, right? But what the real sniper entry would look like is your patience to wait for the manipulation of the early buyers or the early entries. That's how market makers move the market. That's how institutions think. Institutions don't want to be in the market dragging space with you. They need a free flow of pricing, right? So that they can be able to chase better liquidity. They don't want that noise with you. So what they will do is to first take out every liquidity and make you think the market is not going to go in your direction again. So what they simply do is they like to trap buyers and sellers. So for people who were trying to buy here, they've taken out their liquidity. For people who were selling here, they've rolled out their liquidity too as well. So what I'm trying to explain to you now is how to catch this sniper entry here. So what then happened, like I was saying, the divergence. So the divergence is when for a bullish divergence, the RSI is your chart is making a lower low, lower high, lower low situation like this, but your RSI is making a lower low, lower high situation like this. This becomes a divergence. So the RSI is clearly showing you that momentum is going up, but the chart is telling you that, I'm coming down. So this confusion here is what is called a divergence. So what you want to pay attention to is the RSI, not just the chart any longer. Now, why this is important is this. It doesn't just happen. It happens because market makers try to sweep the early entries. So that sweep that they make is the confusion. So you see that they've made people buy at this point with this huge move. Everybody's trying to buy. And they've also made people think that, oh, the market is not buying again. It has slowed down. So they are now selling. They sell and they break this point where people bought from. And then now people are trapped because now there are people wanting to continue selling. Why? Because they feel like this key level has been broken. So when they feel this key level has been broken now, what do the market makers now do? They now automatically reverse prices. Now they do this exactly when the market is exhausted because the market has proven itself to be exhausted here before. And now they did it here again. And they did it just above the previous exhaustion point. So our strength index is showing us that market is moving higher here, but our chart is showing us that market is moving lower. So this becomes a divergence. And when that happens, when you see the first tap of a key level and prices come back to sweep that key level, now your confirmation for that sniper entry is for this break below the key level, for prices to not stay under that key level, but for prices to go back above that key level and close above it. The moment that happens, that becomes your sniper entry. So what you get is price will do something like this. Okay, so I'm just going to sketch this out. So this is a support. Okay, so prices was trending lower and it came here, went back up, then came down, and then went back up immediately, and then did something like this. Now this becomes your sniper entry. Are we following? Do you understand? If you have a question, please ask. Please ask, because I want to believe I'm really trying to simplify this for us. I'll take 2 minutes to just see your questions.
Cái này. Cái này ra mình lên xin nào.
Okay. So
Follow will. What do you expect? What a man can do, a woman can do.
okay, so if you're following, please just say you're following, please, guys. So I know that we're on the same page, right? Okay, so this is, are there any specific settings for that RSI to be adjusted for the RSI? Yes, please set your RSI to the limit of 75 and 25. 75 and 25. 70 usually is where retailers want to say, okay, market is overbought. Oh, sorry, oversold. No, what am I saying? Overbought. Okay. And 20 and 30 is usually where they think the market is oversold. But institutions do not obey to retail understandings of this thing. So they would always manipulate those levels. So you usually want to get your overbought or oversold level to come below 30. You want it to actually sink below 30. And then you want the second leg to be just above it. Okay, so that is one way to use the divergence method at a key level, right? To make your entries. So your settings for your RSI 25, 75. Don't do 70, don't do 70, 30. 70, 30 is what comes with on your MetaTrader or on your trading view. So adjust your own, go to the settings and adjust it to 75, 25. That's one tip. Try it because you might not see it every day on your 4 hourly time frame, right? But you would see it on your 15 minutes time frame. So what you want to do is you want to play it nice. Okay, if you're a day trader, so if your 1 hour time frame aligns and everything and you find a good key level, check your 5 minutes, 15 minutes time frame, you'll see a divergence. I promise you. Just take it out and back test it. Okay, I'll show you another example of this same move, right? Now, let's go to why I'm taking this trade currently. Okay, why I'm taking this trade currently, and I'll show you exactly the same thing to why I'm taking this trade currently. Now, what I want you to first identify, okay, I'll take this out. Okay, what I want you to identify, number one, key level. Remember, we've been talking about key level and bias. So now I know I'm bullish, right? So my bias is bullish, right? And I said the stocks are having like a beautiful 10 days run. So they've been bullish and they're all targeting higher liquidity, right? So now we have this key level. Why is it a key level? Because it's reacted. I'm teaching you guys basics while I'm carrying you along. So this is a key level because prices have reacted here, here, here. Okay, we've seen this reaction severally. So this is a level that prices have respected continuously. Now I don't just use one line to draw my key level. I like to draw them as zones. Okay, so this is a zone. Right now, the reason why I took these buys on US 30 from here, I'll show you guys on my other. So let's open it here so we can relate it together. Okay. Let's go to my 15 minutes time frame where I entered that trade from, right? So this is my entry on the trade. Good. So let's come back here. The reason why I entered this trade is, number one, there was a key level. Not just any key level, but a major key level. Support, 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 resistance. Acted as a resistance. This same level acted as a resistance on Thursday last week. Prices sold off and prices broke above it. So what does that tell me? That what? Resistance, if resistance break, resistance becomes what? Support. Good. Now, when you come to the 1 hour time frame, we see it clearly. It wasn't just a regular support level or a regular resistance level, but it was a resistance level that was clearly used as a liquidity trap because for some reason it acted here on Tuesday, which is just yesterday, as some sort of double top, meaning that there were a lot of buyers, there were a lot of sellers trying to sell at this point, and prices swept all their liquidity. So meaning that this place here has now become a flip area or a flip zone. So we've moved from what? From resistance to what? To support. Now I come back to my 30 minutes. Okay, I think my network is starting to act out here. Are you guys with me? Can you guys hear me? Okay. I think my network is back. So you come here, and then you see that there is a valid order block that was here. This was what led to the break of this level here. Okay, so after this bearish candle, then this bullish candle came into effect and took out the liquidity here. So I knew my order block was here. Not just that my order block was there, but I also had things to confirm my order block, like my internal liquidity inducement here that happened with the buyers here, right? That wasn't it for me. But that was part of my bias and my analysis. Now, what I want to show you is my trigger. Stay with me, okay? Stay with me, guys. So this is my trigger. So let's go back and let's draw this. Why is my network slow all of a sudden? Okay, so let's draw this key level well again, please, because I want you people to see what I just explained to you properly. Come on, MTN. Come on, MTN. Okay, so let's plot this. Let's plot this key level well. Okay, so let's plot it well. Good. So we'll go back to by 15 minutes time frame now. Now, when prices came to this 15 minutes time frame, I want you to notice something. Okay, guys, please stay with me. Okay, can you see how prices came into this level here and tried to buy from this point? Can you see how prices kept trying to buy until when? Until prices finally broke down from the key level and then went back above it. But it's coming back down was to actually tap this other block that I had here, right? And then it tapped it and then it went back up. Now, see something. Guys, are you with me? Can you see my RSI? I can't remember what I said. It said you might not see that divergence on your 4 hourly time frame because you won't get here every time. But if you are in alignment with your 1 hour structure, yeah, the time frame, you definitely get your divergence if you can identify a key level. So this is it. So look, prices came here. Can you see? Can you see the first touch? This was the first touch here. This was the first touch of the key level. And what did prices do? Prices acted like you wanted to buy. So what happened to the RSI? The RSI fell what? Below 30 and came all the way towards 25. Can we see it? Came all the way below 30 to 25. Now, what started happening here? Prices started to create lower lows and lower highs coming back down. But look, the RSI wasn't creating lower lows and lower highs. Can you see when the market was bullish here? Okay, can you see that the RSI was also bullish? Can you see the RSI was going up? But when this sale happened and prices started to buy, and price wanted to buy here, the RSI became what? Bullish. The RSI is bullish, but what? The market is what? Is bearish. Now that's the confusion. That's the divergence we're looking for. When prices finally broke out of this key level and went back above it, what happened? We now have the divergence here. So lower lows, but lower highs on the RSI. Yes, it's good to look for your candlestick, pattern confirmation and all of those things. But what did I now see? There's this engulfing bar finally here, and then prices went back into this level here. What did that also show me? I had something like a double bottom here inside my demand level, and my RSI is showing me what? Divergence. So what did I do? I entered my trade immediately. Just so you don't, so that I can show you proof. So it's not that you're thinking is one of those. So you're not thinking is one of those. So you're not thinking is one of those. Can you see it? Can you see the trade? Can you see the trade, guys? Okay. So I'm trying to focus it so you can see the trade. Can you see the trade, guys? So this is the trade. So let me show you my entry points. Let me show you my entry points. Can you see? Can you see my entry points? Can you see the entry points? Can you see all my entries? Can you see the exact entry points? If you can see my screen, guys, tell me you can see my screen and you can see the entry points. So from exactly that point, that's the same thing. That's the same thing that I am showing you now. So you know that it works. It's not that I'm lying to you. It is working. And I am currently up about 30% of this account that I'm trading. Okay. So this is one of the easiest ways you can get a sniper entry. You just have to build the patience to wait for it. Don't chase it. Wait for it to present itself. Know that this is what I've shown you now is an execution method. Now, what would my entry point, what would my exit point be for this trade, for instance? Now, my exit point for this trade now would be 48,600 area here. This 48,580 and this point here. So I need this place to break, okay, before market closes. I need this place to stay above 48,500. I want prices to close above here. And market is going to close in about 3 minutes time. Okay, so I want this candle to close above here. So I want to be within this fair value here. Okay, so this huge imbalance, this was the last point of interaction between buyers and sellers here, but this was pure sellers. So I need buyers to reclaim this point. So this would be where I will be looking to exit my positions. And if prices, bulls into this place and breaks above it, right, that would be good for me. So I might hold till this new highs. But anything from this point, I might start to look to take profit. But even though I know that this is supposed to be very bullish, but it would be me trying to safeguard my profits, right? You always want to take money out of the market as much as you can. Sometimes we fall victim of giving our money back to the market. But when you're seriously inclined and you mean to trade, don't leave your money for the market to take it. Always take your money from the market, right? Take your profits. You're in this game to make money, not to, you're not here to, what's the word? You're not here to prove right to the markets that you know what you're doing. You're here to do what you do and get what you want and you move. Okay. So this is one of the simplest things I can show you about making a sniper entry. You don't have to overcomplicate it. There are different things you can wait for. You can wait for a break of structure, change in character. That also works. And there's a way to do it. I would have loved to show you guys that today, but I can't show you now. I'm going to show you another very simple method, okay, to use to catch sniper entries. Very simple and very quick. And we're going to do this one we're going to do this one on this same US30 chart, and we're going to do it in under 10 minutes so we can get done with the call. Okay, so we're also going to be focusing on key levels. Okay, pay attention. We're going to be focusing on key levels. So now we want to always identify on the higher time frame, on your 4-hour time frame. Okay, so where you want to do this on your 4-hour time frame. Okay, so what you want to do on your 4-hour time frame is you want to find a key level like this. You want to find a key level like this. Okay, that's number one. A key level is not just a resistance or a support. It's a level that has proven itself to have acted as a support and acted as a resistance in different period of time. So from the past to the present, whatever the case may be, that's what we want to do. Now, the next thing you want to do is you want to get prices to approach a key level, okay, and do one of these two things. Either it bounces off that key level and breaks structure, or it breaks below that key level and do something I call a revalidation. And it does something I call a revalidation. Now, what's a revalidation? A revalidation is what you call break and retest. Okay?